Let's get further into these markets. All right, jobs. You think they're going to surprise to the downside? Why?
So I think that the US deterioration of the data has been really, really rapid recently. I think it's from a very strong base. And I think one of my central premises of the past year, which is why I've been bullish yields and bullish the dollar, is that the US economy will hold up better than people think. Excuse me. And therefore, I think that the consumer is a large part of it holding up well. I think suddenly the PMIs, the ISMs this week have all shown a rapid period of weakness. Now, it's a period of weakness from strength. So because of that, I think we're probably changing the dynamic on jobs finally. The jobs market has been incredibly strong, but given that we've seen soft prints in ADP and what we've been seeing recently in kind of the BMIs and ISMs, I think we might see NFP finally tick a little bit lower than expectations.
Well, translate this into the equity market, for example, Mark. If that's what they're rallying on, perhaps this view that data is deteriorating, the Fed, they're not going to be able to get all the way up to 5% or more. The pause, the pivot, whatever you want to call it, will happen sooner. But is this time around, is that actually a good thing for risk markets, considering the result of which might be a weaker economy and an earnings recession?
No, it's not a good thing for markets, but equities traders are very short-term in this kind of dynamic. And I should say that I think the Fed will get up to 5%, and I think they'll stay higher for longer. Ultimately, they have an inflation problem to deal with. It's just that I don't think they're going to go much higher, perhaps. So I don't think this really changed the market narrative that we've been talking all year. We are always thought that we are due for a bond rally and an equity relief rally into year-end, into kind of the December FOMC was maybe the kind of changing point. I think that really hasn't changed much. I think what's changing is the dynamic for next year. I don't think it should change how you're viewing the market now. We always thought this was kind of a relief rally. At some point, this is going to fade. And I think the December meeting will remind people they are still nervous about the inflation dynamic. They are still looking to hike rates higher than we've got them now, and they're still looking to keep them there longer. Sure, the pace is going to slow down, but we've known that for more than a month.
Okay, but if the Fed is going to go more than 5%, I mean, how do they do that, Mark, if we are seeing that data deterioration? Aren't the two things a bit opposed to each other?
No, they want a recession. They needed to cause a significant curbing of aggregate demand, i.e. a recession. They need to cause job losses to get the inflation problem under control. Now, they don't necessarily want to send us a dangerous spiral, but they need to make sure we get to that recession. So right now, we're seeing a sudden softening of data from strength. But if the Fed suddenly said, hey, we're stopping, we're a foot off the inflation threat, then we might not get that recession. They need to cause a recession. So I think that the Fed is going to have to hike a few more times. I think they'll probably get to 5%. How much higher they'll go, I don't know, but I think they'll get there, and I think they'll stay there for a long period of time because they need to cause this recession. They're only going to pivot when they see the economy really, really collapse or something that we don't anticipate break up. And at the moment, because we don't anticipate, we don't know what that is. So for the moment, I think the dynamic for the markets are still the same. I think equities will give back their recent gains next year. I think the first quarter will be a turnaround in negative for equities.